Hello and welcome to Wrestling with Real Estate, where we look to choke slam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multi-family real estate investor, Barri Griffiths. Now today we're joined again by the lovely Lisa Hylton. Hey Lisa.
Yes, thank you for having me, Barry. Happy to be here.
It's absolutely my pleasure. We just got done wrapping the first part, talking more about Lisa's story and her progression and everything that went along with that. So very cool interview. Please go and check out that first part, guys. It's a really, really good one. But the second part, we're going to really take a deep dive into syndication and how passive investors should analyze a multifamily deal, right?
Yeah.
So, because it's very important, right? You know, unless you understand this, even being passive, right? It is passive, but there is some active stuff that you've got to understand and got to know what you're doing. So, what are some important stuff you think and that you've picked up along the way?
Totally. Couple things here. The first thing is, one, getting to know sponsors. I think it's really important to know who is managing the deal. So who's going to be operating the deal? Why is this important? You want to understand what their track record is. If what they're getting ready to do is work that they have done in the past. And it's okay to work with someone who they are doing this for the first time, as long as they're partnering with someone else who this is not their first rodeo, because you want to limit something that's called execution risk. So super important to limit your execution risk on your money. You're working super hard for it. So I think that's the first place I would start. Like, I can pause there. We can go on further deeper, but let me know how you want to proceed.
Yeah. So how would you? How would you vet the syndicators, the operators themselves?
Yeah. So a couple things I typically like to do is, one, you're listening to a podcast like this, go to their website, sign up to invest with them. That enables you to get on a call. And it also enables you to get on their email communication. So you begin to be a part of their network and see what it is that they are providing to investors. And then through getting on a call, you'll learn about them. They'll learn about you. This is a great time to just get some preliminary information about who they are, and just to get to know them. Also a good time to talk about what is their track record. Many of them after this call will then send and share with you what their track record is, like some of the deals that they've done, so case studies on deals, how they've performed, et cetera, et cetera. This is a good time to sort of look at those deals and ask questions. Potentially, even if they reach out to have a follow-up call, or you can reach out to have a follow-up call with them with any kind of questions that you have from looking at some of the deals that they have had. Why is it important to do this stuff? I think it's important because you want to be able to, during this time, see how people respond to the questions that you ask them. Why would you wait until after you've invested money to then see how people ask questions, answer questions that you have? You would prefer to then work with people now to go through the process of how they answer those questions and what their process is. So that's what I would say is really important there. Some of the other things that I think are very key for passive investors as they're looking at deals. So once you've gotten comfortable with the operator, I think that's the first thing. That's the first thing you need to do. It's absolutely crucial and essential. After you're done that, now you're getting deals. So as you get a deal, the first thing I look at is, where is this deal located? What's the market is it in? And I'm looking to see what's the job growth in this particular market, what's the population growth in this market. Just those two things alone will enable me, and you can go online, you can just Google Atlanta population growth. You can also go online and just Google Atlanta jobs, just to see what's the news around jobs and employers in that particular market and area. So that's how you can do that kind of research super fast, to then sort of see, okay, is this a market I want to be in? And if it is a market you want to be in, then you go further. Now you're looking at, okay, where's this deal located in this particular market? Based on that if it's if it's somewhere far, you're dealing with Texas and maybe it's in like oil country, for instance, in Texas, as opposed to like Dallas, you want to sort of keep that in mind. And then that helps you to determine whether you want to dig deeper or further along. But I'll pause there.
Yeah. When you're looking at population and job growth, what is a good population growth? Any kind of population growth, or do you want a certain metric? The same with job growth. Are you looking for a certain kind of metric, or is just any kind of growth good?
Yeah, great question. So I like to look at trends. So the thing about when you go online, chances are it's not like super recent. Like you're going to see up to like maybe like 2017, 2018 the most, right? But I'm primarily looking at what the trends are like over the past 10 years. And then, that sort of helps me to like sort of discern whether this, like what kind of market I'm dealing with. If I'm dealing with a market where it's been flat, it doesn't necessarily mean it's a bad thing. It just means that it's probably going to be a market that's more conducive for cash flow than it is for appreciation. Whereas if I see a market where it's trending down, like Detroit, for instance, like then you just need to know what you're doing. Like, why are you choosing to invest in that market? Maybe like there's a particular situation that is going on in that market that makes it beneficial for you. And if that's the case, then go for it. But typically I like to sort of see the trending going up. I'd want to see about a 10% increase over the past 10 years or so, somewhere in that ballpark range from a 10-year point of view. But most important for me, I like to see trends going up, and that when I'm looking online for the job information, that I'm seeing employers, organic stuff, not things that are coming from other like people connected to the deal. I mean, like natural stuff going on, like journals and newspapers in that particular area talking about employers coming into town and jobs being available in that area.
Yeah, very cool. Yeah, because this is what drives
Mm-hmm.
multifamily, right? It's people, right? You need
Exactly.
population growth, and you need jobs there for these people to be able to pay their rent. And these are such important drivers that you need to understand where you market, because again, passive investing is not completely passive. You do your work up front, essentially, so then you can enjoy the fruits of that labor further on, and then sit back and get that mailbox money every month.
Correct.
And would you be correct in saying the order that we're going in? So we're starting with the operators, now going to the market, and then next I'm sure we're going to talk about the actual deal. Is that the level? Yeah. Is that the how do you go in terms of importance? That's how I
approach it. Mm-hmm. Yes, that's how I approach it. Because now we've done the operator, we've talked about the market. Now we're looking at the deal. I like to see, okay, like what kind of deal is this? Is this a deep value add? Is this a regular value add? Is it a class A, class B, B plus? What kind of deal are we dealing with here? And going back to what I said earlier, like you want to sort of see, is this a part of the operator's wheelhouse? Or is this something new? And are they do they have someone on their team to navigate the execution risk? But just getting super clear about that. So once you know they have people on their team, then it's up to you whether you want your money in a deeper value add project. It's up to like that. I can't choose for investors. They sort of have to then conclude on their own. But knowing this helps you with the next thing, which is what are the returns on this particular deal? So the returns should be reflecting the type of risk that you're taking. So if you are going to be in a class C deep value add, you should expect to see higher returns. So like closer to the 20% IRRs, and like, better types of returns in terms of like cash on cash returns, maybe 10 and above. If you're going to take class C deep value add risk, there should be compensation for what you're, for risking your money in that space. Whereas if you now are going to be investing in a class B plus asset, you can expect to see IRRs of like say 13% and like cash on cash of like 6-7%, because you're not going to be taking as much risk because of the type of asset we're dealing with. And some of those risks are like, less vacancy risk because you're dealing with a better asset, potentially better quality tenant who has the ability to then pay their rent, things like this is like some of the things that you need to think about. And it's not all driven by the amount of return that you're going to be getting. You need to be just cognizant of the fact that by getting some of those higher returns also come with higher risk. And as long as you're okay with that, then we're good to go. The other thing that I look at is the splits between how much of the money is coming from cash flow and how much of it is coming from appreciation. And you can easily do that by looking at like adding up all the cash flow over the year, each year, to see how much does that sum to, and then how much is coming at the end, which is usually broken out for you, to then see, okay, this is what kind of deal it is. Is it typically cash flow driven, or is it appreciation driven, or it's a mixture of both? This just helps you to diversify your portfolio, so that way you don't have everything coming with appreciation. Like some deals are coming with cash flow, some are coming with a mix. The other thing that is super important is the financing. This is critical. So I like to ask people, like, what kind of debt are they putting on this property? You know, are they doing a bridge loan, or is it a permanent loan, agency debt? It's important to know this, because if they are buying like a class B plus asset with a bridge loan, it begs you to ask, why is this happening? Typically, the bridge loans are applicable for these assets like Class C with a deep value add, or some kind of value add that's going to be changing, like that you're going in to help improve like occupancy and, you know, turn tenants and all this kind of stuff, which it then makes sense, you know. And then refis, like that's also very touchy for me as well. Like I don't really like when an asset is contingent, like the returns are contingent on you refiing. I just think, suppose you can't refi, what's gonna happen? Like then you don't, like, you know, then you could lose the asset, like the returns are just not possible, like stuff like that. I think investors need to ask these questions and understand about the loans. It doesn't mean that they don't invest, but they understand the risks. So if something happens, they know that they took that risk and that, you know, it's a part of investing. And they're like, okay, got it. I knew going in that this would have been a risk, and we now are unable to refi for whatever reason. So we now need to do a fire sale.
Yeah, this is excellent. This is excellent because it's important. You know, like you said, people work hard for their money. They save it. They want to invest it, right? And you want to go in with eyes wide open. You want to understand all these different pieces, right? And they can definitely change from deal to deal, and definitely change your outlook on a deal, and you know how you're going to invest your money. So it's important that you understand all this, and I really appreciate you taking the time to explain that, because you did a really good job. There's a lot of
thank you. You appreciate it.
Anyone who's interested, I think they should go back and listen to all of that, because that was really good. But we're going to wrap it up there. Lisa, thank you very much once again for back and being in the second part. If people want to reach out to you, people want to get in touch with you, what's the best way to do so? And you've got an awesome podcast, so please mention that as well.
Yeah, definitely. So I am the host of the Level Up REI Podcast. I drop episodes every Tuesday. So definitely you can go ahead and check it out. I'm on iTunes and all the different YouTube, etc. However, you can find me on my website. So one-stop shop for everything, which is lisahylton.com. And that's Hylton like the hotel, only thing with a Y. And I do have a free ebook. It's Beginner's Guide to Real Estate Syndications, and you can find it at lisahylton.com/ebook.
Very cool, very cool. Well, Lisa, thank you so much once again. This was awesome. Make sure you check out both episodes. And yeah, thank you so much.
Yes, you're welcome. Thank you so much for having me.